This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
Stock revival, at least for today. The Dow and the S&P 500 having one of their best days of the year, ending this wild week on a positive note. But is it safe to say the bottom is in?
Small cap disconnect as big company stocks sizzled today. Small cap shares fizzled after several days of gains. What's ailing the little guys this year, and where are the bargains now?
And deepening divide, the public disagreement within the Federal Reserve over what it should do next. We have all that and more on Nightly Business Report for Friday, October 17th.
Good evening, everyone, and welcome. Rarely in recent years has a Friday been so welcome on Wall Street, and this, thankfully for the most part, was a Friday of healing for stocks after a week that laid bare practically every one of the market's vulnerabilities. Today, the Dow Jones Industrial Average ended a 6-day losing streak, a slide marked by the kind of turbulence investors hadn't seen in years. It shot up 263 points, buoyed by strong earnings, some good economic news, and a fierce rally overseas in European stocks. All 30 Dow blue chips ended in the green. The Nasdaq gained 41 points, and the S&P was up 24 points. For the week, though, it was the fourth week in a row of losses. The Dow fell 1%. The Nasdaq was down less than 0.5%, and the S&P also lost about 1%. But those numbers mask a truly unsettling week for stocks. And by the way, for the 10-year Treasury. It took a magical mystery tour of its own this week before ending with a yield of roughly 2.2%. And that was roughly where it was a week ago. Bob Pisani now on the wild week that was in the markets and whether investors have seen the worst for a while.
Large cap stocks staged a big rally, though not enough to bring the S&P 500 into positive territory for the week. The initial catalyst was comments from a European Central Bank representative that they would begin buying assets to support the market in a matter of days. That was news, and stocks moved up. Now, is this a bottom? This is very tough to call. There's two issues. The first is that slowdown in Europe. That has not been resolved. European leaders still need to enact reforms. But today's comments indicate that the central bank there is willing to keep rates low and begin buying assets to support the market. So the issue is not resolved, but it's looking better from an investor perspective. The second big issue is Ebola. No one knows how to model this, and this is a real X factor for stocks. This could be a non-issue in a month, or it could be a big problem. We don't know. Travel stocks like airlines and cruise ships, which have been sold heavily this week, all rallied today, but that's just today. And the rally, by the way, was largely a big cap event today. The S&P 500 was up on the day, but the small cap Russell 2000 turned negative in midday. But the Russell outperformed the S&P all week, so it's likely the S&P is just playing catch up. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
During this week's market turmoil, investors witnessed a sort of David and Goliath scenario, with small cap stocks easily outperforming much larger companies and the overall market as well. Could this signal an opportunity for investors to make a big move into small caps? Morgan Brennan takes a look.
It's been a rough couple months for small cap stocks, with the Russell 2000 down roughly 10% from its July high. Investors have watched the group closely because they are seen as an indicator for the broader market. But this week, the index saw something of a rally, outperforming the larger Dow Jones Industrial Average and the S&P 500 in what was a very tumultuous week for stocks. Some experts say this may be the start of a new trend for small caps and possibly for the markets.
We have seen the bottom and that we're going to have a pretty good fourth quarter in terms of performance. So our goal is to get back to at least break even for small cap performance on a year-to-date basis by the end of the year.
Small caps are smaller publicly traded companies with a market capitalization of $300 million to $2 billion. They're high momentum and tend to experience bigger swings than the larger, more stable blue chip stocks. But unlike the big multinational companies on the Dow, The small caps derive more than 80% of their revenue on average from the U.S., so they're more insulated from foreign market turmoil and currency headwinds associated with a stronger dollar. Analysts say small caps looked expensive for most of the year, but the recent sell-off has made them more fairly valued. As investors worry about slowing growth abroad, these stocks could become an increasingly attractive investment.
If the U.S. economy holds in there and we get to see a little bit of GDP growth, I think earnings estimates, especially for the third quarter, look pretty reasonable. And so I think you're going to see some pretty big beats, and that'll drive performance.
For that reason, DeSantis likes tech companies and industrials, but he remains wary of consumer discretionary, particularly retailers. Nonetheless, there are plenty of risks. Small caps are very volatile, and that's expected to continue. They're also more sensitive to interest rate hikes, one reason the Russell 2000 tumbled in the first place. And analysts warn that it's important to be picky, to do research and invest in certain stocks specifically. For Nightly Business Report, I'm Morgan Brennan.
Mike Balkin joins us now to talk more about what's going on in those small cap stocks, which remain down about 7% for the year and off about 10% from their intraday summertime highs. Mike, welcome. Good to see you. I guess we shouldn't be surprised that small caps have been more volatile than big company shares all summer. They're doing what we kind of expect them to do, aren't they?
Well, certainly they're doing what we expect them to do. Usually October is one of the worst months for small cap performance out of the year each time. And again, we're not really surprised. Maybe the volatility's been a little more than most would have expected. But given the strong performance that small caps had last year and the first part of this year, it's not a surprise to us.
So is the new trend to buy small caps? Is this the time to start filling your portfolio with some of these smaller companies?
Well, we certainly think so. We have found valuations to be somewhat challenging for a good part of the year, and the last few weeks have given us a lot of great buying opportunities. I know some of our analysts are salivating at where some of the stocks have gone here over the last few weeks. So we think this is a good time to be buying small caps, and that's not to say there's not going to be a few more bumps in the road along the way, but small caps tend to act somewhat poorly going into midterm elections and then tend to act pretty well coming out of that. So I wouldn't expect this time to be any different.
So I don't want you to show your hand totally here, but you say you've been buying. What have you been buying?
Well, I tell you, I'd have to shoot you if I told you what we'd be buying, but there's a lot of tech stocks that look a lot more interesting to us right now, and we're actually starting to dabble a little bit around the edges on some of the consumer names. But I think on the whole, things are looking a lot more interesting across all the sectors.
But you know, Mike, it is hard to find good small caps. I mean, how do you even research this if you're an individual investor? With the large caps, you know to look at the blue chips, some of the big household names, some of the biggest companies in America. But when it comes to small caps, even Morgan, when she was reporting, says you've got to be selective and picky. Are you better off just buying into a small cap fund like yours? Or how do you identify these small winners?
Well, I'll tell you, I mean, again, I think buying a fund makes a lot more sense. Now, again, I'm biased since I do run a small cap fund, but I think it's very difficult to go out on your own and do a lot of research on these small companies. We've got 10 analysts across all the different sectors scouring across the nation looking for some of the best small cap ideas out there. And I think that, again, that's the way to do it. And buying companies with good fundamentals at good valuations, over the long run, you're going to make good money there.
Is the economic climate, in your view, right now favorable to small caps? In other words, you know, large cap shares are vulnerable, I think, to a rising dollar. Small caps less so because they derive most of their income from domestic sales.
Yeah, I think that's right. I mean, again, small caps being less liquid do tend to be a lot more volatile than the large caps. But I think people right now, early in the year, it was let's buy the large cap stocks with good international exposure because everybody thought that Europe was recovering and China was getting stronger. And now some of the more recent news we're seeing is that Europe's weakening and China's slowing down a little bit. So people are scurrying back to the United States and buying some of the small cap companies.
All right,
I think
Mike,
that's part of what's happening here.
Mike, thank you very much for steering us through those shoals of the small company shares. Mike is with the William Blair Small Cap Fund.
Turning to the oil markets now, oil prices rose along with stocks today, bouncing off of four-year lows, but not by much. Domestic crude added 5 cents a barrel, closing at $82.75. Brent crude rose by 34 cents a barrel. For the week, West Texas Intermediate fell 3.5%, down for the fourth week in a row. Brent crude was lower for the third straight week by almost 5%.
More now on those strong before-the-bell earnings we mentioned at the top of the broadcast. One of the big drivers in the Dow today was General Electric. It reported an earnings beat last quarter, outstripping analyst forecasts. Profits up 13% after the industrial giant sold more jet engines and more oil and gas drilling gear. Shares today up more than 2%.
Also topping Wall Street estimates, Morgan Stanley. Profits at the investment bank surged 87% in the third quarter, thanks to a jump in stock and bond trading and in the firm's wealth management unit. Morgan Stanley shares rose 2% today to $33.22.
And in economic news, some good news about housing. Construction of new homes up more than 6% last month, thanks to a spike in new apartment buildings and multifamily units. That helped send shares of some of the nation's largest home builders through the roof today. Take a look there. D.R. Horton, KB Homes, Hovnanian, each up 6%. Lennar, Pulte up more than 4%.
Meanwhile, mortgage giants Fannie Mae and Freddie Mac are close to a deal with lenders that would greatly expand credit to would-be home buyers while protecting those same lenders from allegations of making bad loans. Over the last few years, Fannie and Freddie have reaped tens of billions of dollars in penalties from lenders because of underwriting mistakes on loans sold to those government guarantors. Lenders have blamed those penalties for forcing them to tighten credit restrictions.
Well, like a house divided, some public disagreement from members of the Federal Reserve about when exactly to stop pumping the money spigot and raise benchmark interest rates. So will the Fed rethink what to do about the bond buying program that sounds like a cruise ship? QE3. Steve Leisman takes a look.
Well, recent market turmoil, low inflation, and global economic weakness prompt the Federal Reserve to delay plans to end its bond buying program at its meeting just 2 weeks away. There's something of a public disagreement within the Fed on the matter. Boston Fed President Eric Rosengren, in an interview, suggested the Fed is likely to follow through on plans to end the two-year-old quantitative easing program, otherwise known as QE, later this month.
We have made a lot of progress in labor markets. We're at 5.9% on the unemployment rate. We were much higher at the outset of the program. The program was really designed that once we made substantial progress on the unemployment rate and labor markets more generally, that program would end. If it looks like we're not going to get that kind of progress now and going forward, then we'd have to reconsider it. But I'd be surprised if in the next 2 weeks we get enough data to make us change our mind on that.
Rosengren, one of the doves on the rate-setting Federal Open Market Committee, did say the Fed needs to monitor Europe carefully. Cheaper oil and a more expensive dollar, he said, would keep inflation below the Fed's 2% target for some time. But his comments on QE seemed at odds with those of St. Louis Fed President Jim Bullard. He said Thursday the Fed should delay ending the program because of low expected inflation. It's unclear where Fed Chair Janet Yellen comes down. She spoke today at the Boston Fed's conference alongside Rosengren, but she made no mention of current monetary policy. Instead, she spoke about income inequality.
The extent of and continuing increase in inequality in the United States greatly concern me. The past several decades have seen the most sustained rise in inequality since the 19th century. I think it's appropriate to ask whether this trend is compatible with values rooted in our nation's history.
If you really want to read the tea leaves, the absence of any comment on current economic policy could be a sign that despite the recent market volatility, Yellen is content, at least for now, to leave in place the market expectation that QE will end as scheduled in October. For Nightly Business Report, I'm Steve Leisman.
Still ahead, looking for some steady Eddie stocks to buy and hold in this volatile market. Our next guest has a list of recommendations. That's next.
The U.S. now has an Ebola czar. President Obama has tapped trusted political advisor Ron Klain, a one-time chief of staff to Vice Presidents Joe Biden and Al Gore, to spearhead the government's response to the deadly virus. He will, of course, closely monitor the care of those 2 Dallas nurses who contracted the disease from an infected patient who later died. Meantime, the drug maker Chimerix has gotten FDA approval to test its experimental antiviral drug on Ebola patients. Still, shares of Chimerix fell 3.5% today, as you see, while shares of the rival Ebola drug maker Sarepta Therapeutics, which said its drug has no bad side effects, well, they were down a fraction.
Honeywell may be in a buying mood, and that's where we begin tonight's market focus. The company says it's considering potential acquisition targets after it posted better than expected third-quarter profits and raised its earnings and revenue outlook for the year. Its strong quarter was driven by sales gains in almost all of its units. Shares rose more than 4% to $90 and change. Bank of New York Mellon saw its profit rise as it made more money from investment fees in its third quarter, but revenue came in below analyst estimates. Still, the stock was up 20 cents to $36.36. Textron reported a 60% jump in quarterly profit thanks to a lift in higher deliveries in its aviation unit. Encouraged by that strong demand, the maker of Cessna jets also raised its full-year earnings forecast. Shares rose about $3 to $36.65. Amgen has filed a patent infringement lawsuit against Regeneron Pharmaceuticals and Sanofi over their experimental cholesterol drug. The suit alleges that the two companies are violating 3 of Amgen's patents, and it's seeking to stop the companies from marketing their drug. Despite the legal battle, though, shares of all 3 companies ended higher, with Regeneron up more than 8%.
Mead Johnson rose today on takeover rumors. The French food giant Danone reportedly has its eye on the company as a takeover target. That sent shares of that firm up about 10% to $100.23. CF Industries and Norway's Yara International have called off their $30 billion merger deal. That deal would have created a massive player in the fertilizer industry. Apparently, the two firms couldn't agree on the terms of the combination. The shares of CF down 3.5% today to $244.96. News that Cliffs Natural will take a big charge in its third quarter, sent shares tumbling. The mining company said it would write down the value of its coal and iron ore assets by $6 billion because of weak prices. The stock fell 8% to $8.74. And General Motors top lawyer Michael Milliken is retiring next year. Milliken's department was heavily criticized for how it handled the ignition switch recall that has now been linked to at least 27 deaths. The automaker says it will immediately begin an external search for his replacement. Shares of GM up 30 cents today. They finished at $30.24.
Our market monitor guest tonight says he's looking beyond the ups and downs of the market and that he's been buying some good quality stocks this week. He's Kevin Caron, portfolio manager at Stifel Private Client Group. Kevin, so nice to have you with us here.
Thank you for having me.
So let's get right to it. Raytheon is at the top of your list. You're saying that this stock over the next 12 months can be up 18%. What's so special about Raytheon?
Well, all 3 of these stocks, and to lead off with Raytheon, the idea is to have very steady companies because we have now gone through a period where we've had an improving economy for 5 years now, and we just want to be thinking about how to get through the next several years, which might be a little bit more difficult at some point. So Raytheon has very good cash flow, excellent balance sheet, is raising its dividend and buying back shares. And ultimately, the business is very sound. They're the maker of Patriot missiles. Geopolitically, given the instability that we have in the Middle East, it's obviously they're in an attractive spot for the products they sell in that region. Mm-hmm.
So that's sort of a bet on an unsafe world in a way.
Well, in a way, but also realize that that this is really a very steady company in terms of their underlying fundamentals. If you look at the cash flow, if you look at their balance sheet, very sound. And ultimately, what we want to do is make sure that the companies we own in the portfolio have those kind of characteristics.
You have a price target there that implies about a 20% gain. Your second choice has a somewhat more modest price target on it. Tell us about that one.
Sure. Now, if we're talking about Intel, correct?
Right.
Okay. So Intel, what we're looking at is a company that obviously is best in its class in terms of being able to deliver very low-cost, very efficient processors for computers. And even though the PC, there's been a lot of talk about the way the PC is going in terms of sales, the one thing we do know is that PCs are getting smaller. That means they need to be able to have very efficient processors. Intel is the leader in the pack in terms of being able to do that kind of work, and there's none other that I think can compete as effectively as Intel, given their size and scope. And then secondly, in terms of the server marketplace, which is very profitable, they are dominant there, and it's growing very nicely. And with trends in business spending expected to pick up, we think they do very well.
You have a healthcare recommendation, Abbott Labs, ABT, on the New York Stock Exchange. A lot of news about Abbott Labs over the last couple of weeks.
Sure. So Abbott Labs is a slimmed down Abbott Labs. They've spun off AbbVie. Now you're looking at a company that's very well diversified in terms of its product mix. They have branded generics. They have their nutraceutical business. They have medical devices. They're also diversified internationally. They have about half of their revenue, just shy of half of their revenue, coming from emerging markets, which are growing very nicely. And they're paying a decent dividend. So overall, you've got a diversified company with a dividend, with a very good balance sheet, consistent profitability, and should be able to get through just about anything the world throws at them in the years to come.
And you're saying that about all three of these stocks, that these are buy and hold, even if the markets do crazy swings over a lot of volatility over the next couple of weeks.
Yeah.
Still do fine.
Yeah. The spot that you just had about small caps, for example, that was indicative of the market over the last few years. That has been very rewarding to companies that have been more exciting. That can't go on forever. So what we're thinking about is how, even though right now we see the economy growing, we see the data coming in very strong on terms of industrial sales and employment, all these things, we want to make sure that over the long term, if and when we do have a slowdown and these more consistent kind of characteristics are demanded by investors, we want to make sure they're positioned in portfolios.
Boring is beautiful, in other words, or it can be in certain markets. Very quick thought here as we end this very turbulent week. What did you make of it? What do you think's ahead?
I think a lot of what we saw this week has to do with discontinuity between the message from central banks, who on one hand are struggling to find ways to continue quantitative easing, and on the other hand,
or start it in Europe.
Or start it in Europe, yes. So you have this kind of conflict, and then you have the fiscal authorities around the world who are dialing back deficits. So one of the difficult things that we are encountering is that the economy is getting better. It's suggesting we need less stimulus, and the market so far has been sponsored largely by QE and then the taper, and now the question is whether we need to start the untaper.
Real quickly, in a word, next week, stocks up, down?
I think we're going to have a volatility for a while to come, but I don't think you fear it, because I think ultimately, as long as the data is moving in the right direction, this is a time to go and look for quality stocks to put in the portfolio.
Kevin, thanks so much for coming by. Have a great weekend. Kevin Karen with Stifel Private Client Group. Tyler?
And still ahead, the iPhone 6 made its debut in China. Did the device wow consumers in one of Apple's most important markets? China's economy is still growing, but at a slower pace than officials there would like. So now China's central bank is planning to inject up to $33 billion into 20 large national and regional banks to boost lending in the world's second largest economy.
Apple's all-new iPhone 6 finally went on sale in China today. So what was the reaction in the world's largest smartphone market? Eunice Yoon reports from Beijing.
The lines outside the Apple stores in China were orderly and calm for the official debut of the iPhone 6, but that doesn't mean people weren't excited about the phones. The launch was delayed by about a month because of a licensing issue, creating a flourishing black market where some fans bought the phones for as much as $3,000. However, people here can now get the iPhone 6 and 6 Plus for more reasonable prices, only a couple $100 more than in the United States. Most of the buyers here like the big screens.
It's 126 gigabytes. I like the white front. The golden color is a bit too flashy.
The iPhone 6 has a bigger screen, better to watch movies on them. It's faster and supports 4G, so it's faster to surf on the internet.
Unofficial reports put pre-orders here at 20 million, though some analysts warn that the figure is likely heavily inflated by eager customers who registered multiple times. China is one of Apple's biggest markets, but the company is facing growing competition here. One local phone shop, though, is doing what it can to help, offering free tailoring services so new buyers can alter pant pockets to fit their new iPhone 6. For Nightly Business Report, I'm Eunice Yoon in Beijing.
And finally tonight, if it can happen to the president, it can happen to just about anyone. While signing an executive order boosting security on federally insured credit and debit cards, President Obama said his personal credit card was rejected at a New York City restaurant last month during a UN visit.
I went to a restaurant up in New York when I was during the UN General Assembly, and my credit card was rejected. It turned out, I guess, I don't use it enough. So they thought there was some fraud going on. Fortunately, Michelle had hers.
Oh, the late night comics, you're going to have a good time with that. The White House press secretary confessed he did not know the current status of the president's card. They know where he lives, after all. He also joked that it is unclear whether he left a tip at the bottom of that executive order he was just
What's
signing.
What's going on? Ben Bernanke can't get a mortgage. Obama can't use his credit card. What's going on? That's Nightly Business Report for us for tonight. Thanks so much for joining us. I'm Susie Garrow.
And I'm Tyler Matheson. Thanks again from me, and have a great weekend, everybody. Monday, right here.
Nightly Business Report has been brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
I'm Susie Garrow with a Nightly Business Report news brief. Stocks on Wall Street surged higher today as the Dow snapped a 6-day losing streak. Investors were encouraged to buy stocks thanks to solid earnings from General Electric, Morgan Stanley, and Honeywell, and good economic news, a boost in new home construction and consumer sentiment now at a 7-year high. The Dow shot up 263 points, the Nasdaq gained 41, and the S&P was up 24 points. But each of the major averages ended lower for the 4th straight week. The White House appointed an Ebola czar to coordinate the government's response to the virus. And President Obama says his personal credit card was rejected at a New York City restaurant last month, likely because he hadn't used it in so long. Be sure to tune into Nightly Business Report right here on your public television station.